What's up everyone, it's Scotty with Money Investing. In this video, we are going to be talking about how to rebalance your portfolio like a pro. So this is going to be an educational video. It's going to be a tutorial, and I'm going to walk you through my spreadsheet here on how you can actually build this on your own and how to actually periodically rebalance your portfolio, because it's really important to do that every so often so you're not over or under allocated in certain stocks or asset classes. So hopefully you get a little bit of insight from this video. Hopefully you find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Of course, if you're just joining us for the first time, and the link to our Discord and Patreon is going to be down below. I'm going to try to do more and more of educational videos, more content that's going to be relatable for you that you can actually take action on in the future. So hope you guys enjoy these videos. Let me know in the comment section down below if you have something very similar in terms of setup. And if you find these videos helpful. So again, without further ado, let's just dive right into it. So this right here is going to be the spreadsheet. Now, the concept of rebalancing is basically the idea of bringing your portfolio back down to your target allocation, right? Target allocation meaning that if you've got a portfolio of different asset classes, let's say stocks, bonds, real estate, cash, and you have a certain percentage allocation. By the way, when we're talking about portfolios, when we're talking about rebalancing, these topics will always be discussed in terms of percentages. They will never be discussed in dollars or euros or pounds. Doesn't really matter. It will always be discussed in percentages because percentages are much easier to relate with, right? If you tell me, for example, I've got XYZ stock, I've invested $10,000 in it. Doesn't tell me anything, right? It's without any context. But if you say the same thing, but instead replace that $10,000 with 10%, now I have a much better understanding. Of course, I need more information, but it gives you more sort of a understanding of that statement, right? I've got 10% of my allocation in XYZ stock, right? That's much better because 10% out of 100%, 1/10 of your portfolio is in that stock versus if you just say like I have $10,000 in that stock, right? $10,000 out of how much, right? We don't know. So we always talk in terms of percentages. That's what really matters when it comes to portfolios. Anyway, so this right here is going to be two methods that I want to go over on how to actually go about rebalancing your portfolio. So I've got an example portfolio over here. So let's just say stocks, bonds, real estate, and cash. For example, this person has $50,000, right? $50,000 in these four asset classes. Stocks, bonds, real estate, and cash are four different asset classes. So let's just keep things very simple. $50,000 in each asset class, totaling $200,000. Now, that is going to be 25% allocation in each, as you can see over here, right? $50,000 divided by the $200,000 total, that is 25% allocation in each asset class. Now, let's just say, for example, in 2023, this happens, right? Stocks end up rallying over 40%. So that's a huge gain, right? 40%, they end up rallying. Bonds, they don't rally as much as stocks. They go up 6%. Real estate, let's just say that it goes up 10%, and cash doesn't go anywhere. So it's only 0%. Now, before, many of you say $50,000 for real estate, what are you investing in? This is an example, guys. This is literally an example. I'm not actually putting in values here. I'm just going over very simple math so you can understand what rebalancing is all about. So 2023, let's just say that these are some of the gains on these asset classes. So how does the portfolio change, right? How does the portfolio change this right here, $50,000? What is it going to be worth? Because for this is going to be that cost value, right? This is the value of the actual cost basis, and the market value, right, is going to be over here. Or in other words, you can call this the end of the year value, right? This is what the values of your stocks, bonds, cash, and real estate is going to be at the end of this year, 2023, if of course we see these hypothetical gains for these assets. So 40% growth is going to turn your $50,000 into $70,000. $50,000 in bonds, 6% gain is going to be $53,000. Real estate, 10% gain, $55,000. In cash, no gain, is going to stay put at $50,000. So now the total of this market value ends up at $228,000. So the portfolio has grown, right? It's grown from $200,000 to over $228,000. So now if you do the calculation, same calculation as we did earlier for 25%, which is simply taking into account $50,000 divided by 200 to understand that asset allocation. If you do that same exact calculation, these numbers have changed. Why? Because some assets have grown at a much higher rate than others. So your new allocation looks like this. Now, stocks make up 31% of the portfolio. Bonds make up 23%. We've got real estate, which is 24%, and cash, 22%. So you can already start to see if this is your target, right? If this is your target and this is your actual, you can already start to understand the discrepancy between your target allocation and your actual allocation. So this is the concept of overweight and underweight, right? In a portfolio, right? You can be overweight and underweight certain stocks, certain assets, different ETFs. It can work in many different ways. It can be cryptos, gold, whatever it is, right? Different asset classes. That's how portfolios are built with respect to overweight, underweight allocations to certain asset classes, stocks, ETFs, whatever it is. So in this example, now after 1 year, after the 40% gain in stocks, you are now overweight equities because their target allocation was 25 and we are now at 31%. Same thing applies to bonds, real estate, and cash. You can see that bonds, it's a little bit underweight at 23%. We've got real estate from 25 to 24%, so slightly underweight, and cash significantly underweight from 25 to 22%. So method number one on how to recalibrate this portfolio back into its actual value is going to be sell and redirect, right? That is the number one way, and probably the most popular way of rebalancing is by selling certain stocks or ETFs or asset classes and then redirecting it into another one, which is right now underweight, right? Which is you are underallocated into that stock, ETF, or asset class. So that's going to be number one. And in this example, what you would do is you would simply would want the 25% target to be achieved. So if your market value is at $228,000 and 25% is the target, as we have looked at over here, 25% for each asset class, and the market value is $228,000. So you simply do the math and your target allocation for each asset class comes at $57,000. And the simple fix is going to be selling equities worth $13,000 and reallocating those assets or those funds into these other assets in this manner. $4,000 in bonds, $2,000 in real estate, $7,000 in cash to bring your market values back aligned at 25% each. And that is rebalancing through method number one, which is sell and redirect. Now you do, of course, end up taking a tax consequence because of selling $13,000 worth of equities, but that is the cost for rebalancing. Of course, if you're doing it in a Roth IRA or in a tax advantage account, it's going to be a lot better as opposed to an account which is, again, taxable. So those are some things to definitely pay attention to. But there is another way to do it, which is a lot more expensive, but you're not going to be paying taxes on it, to rebalance the portfolio. And that is going to be method number two, which is going to be simply buy more, right? Instead of selling the one that's actually overweight, you can simply allocate more funds. If you have cash on the sidelines, if you have more funds on the sidelines, you can buy more of the underweight assets or stocks in order to bump up their percentages so that the portfolio is once again rebalanced back to its target. So going back to our previous example, again, $50,000 in each, 25% each allocation, same gains in 2023, same ending value, $228,000 market value, and this is going to be the actual percentage allocation, the new allocation. And the fix in this case obviously is going to be a lot more expensive because you're going to need to buy $17,000 worth of bonds, $13,000 worth of real estate, and $18,000 worth of cash just to reallocate or pretty much bring those assets back to their target allocation of 25%. So those right there are going to be the two methods on how one can actually go about rebalancing their portfolio. This applies not just to asset classes, but individual stocks as well, right? So I've got an example here to share with you, which is going to be a very simple example to help you better understand the power of rebalancing portfolios, because not only does it allow you to lock in some profits, lock in some gains, and trim some positions, but also allows you to continue in that process of maintaining that portfolio balance with your target allocation, right? So you're making sure that you're not overexposed or over allocated to one certain stock, and you're not underexposed or under allocated to your, potentially some other stocks or ETFs or asset classes. So your target allocation obviously depends on you, right? Nobody can decide that for you. You need to decide what is going to be that target allocation, right? Do you want to be 80% stocks, 20% bonds, 60% stocks, 40% bonds? If you want to be within stocks, what your allocation needs to be, tech, energy, financials, all these different sectors. Of course, it can also be S&P 500, Vanguard ETF, What part of that is going to be a growth ETF versus value ETF versus dividend ETF versus bond ETF. So you have to decide what those target allocations are going to look like. There are billions of ways one can build and construct a portfolio because there's so many instruments out there. So the best person to actually figure out their target allocations between different assets and stocks and ETFs and instruments is you. You have to decide that for yourself. Obviously, there's other financial advisors. Everybody else can kind of help you with it. But at the end of the day, it's you who has to decide for it because this is where your money's going to, right? This is literally where you are allocating your funds. And if these assets perform, of course, your net worth and your finances will grow. If these assets don't end up performing, I know people that have 100% in Bitcoin, right? That's their target allocation. That's the risk that they're willing to take. So this right here is a very simple example, right? So we've got 7 of the largest cap stocks here. So Apple, Microsoft, Nvidia, Tesla, AMD, Google, and Meta. To keep things simple, again, I've put in let's say $10,000 in Apple, $15,000 in Microsoft, so on and so forth. And the total portfolio value is close to $100,000. That's your cost value. And this is your target allocation, right? 10, 15, 20%. In each stock, you can kind of see that for yourself. Corresponded Microsoft 15, Nvidia 20, Tesla 20, AMD 10, Google 15, Meta 10. And let's just say that this is the gain or the loss over the next year, right, in 2023. I've only put negative 20% for Meta because Meta is definitely the one that's been hated the most. So negative 20%, but we got Apple 20% gain, Microsoft 20% gain. I've put Nvidia and Tesla at 150, 120% gain. So absolutely staggering performance from these two stocks in this hypothetical example. Again, this is only an example right now that I'm sharing. And then of course we got AMD at 10%, Google at 8%, and Meta dropping 20%. Now, of course, your cost value will change, right? So market value is going to turn into this. So your Nvidia $20,000 turns into $50,000. Tesla $20,000 turns into $44,000, so on and so forth. You can kind of go across down here and see how the market value changes depending on what those gains are. And then this right here is going to be that total, $159,200. So your total actual gain in this hypothetical example ends up being 59.2%, right? So that's going to be that gain, 59.2%. That's fantastic, pretty good. You're crushing it in the markets. But then comes the question of allocation, right? In terms of rebalancing. And rebalancing is actually recommended periodically, like once a quarter or at least once a year, so that you can actually understand, okay, which stocks you're overweight, underweight, where do you need to be allocated more versus where you're already allocated too much. So that is generally recommended, once a quarter or at least once a year if you can. And this right here is going to be the actual allocations, right? So this is where the allocation ends up being. So I'm just going to write that down. Allocation. So from about 10%, Apple went down to 8%. From 15%, Microsoft went down to 11%. And look what happened to Nvidia and Tesla. Since they rallied so much, since they've gone up like 150, 120% respectively, Nvidia's allocation was 20%. That was the target, jumped up to 31%. Tesla, 20% to over 28%. And the reason why this is so important is because if you consider this, right, Nvidia and Tesla, earlier the target allocation was 40%. Now, because the stock prices have rallied so much, your 40% allocation combined now is almost 60%, right? So 59% to be precise. So in other words, your 7-stock portfolio in this example, 60% of that is in 2 stocks, right? That's why it's so important to constantly be aware of what your allocations are. So how do you fix this? Once again, you simply run through some analysis, and if this is your target, right, and this is your actual allocation after the stocks run up, what you simply do is you simply, subtract, right? So 10 minus 8 is going to be minus 2. That means you are underweight Apple, right? If this is minus 4%, that means you're underweight Microsoft. This is Nvidia, this is Tesla. That means you're overweight in these 2 companies. And then of course you're underweight in these stocks. That's the concept of being underweight versus overweight in certain stocks, certain ETFs or asset classes, or whatever it is that you're tracking in your portfolio in order to rebalance. And since these are your target allocations, once again, you simply run through the math, and this is going to be that target dollar amount in terms of your market value that it needs to be. So what action needs to be taken? Well, it's very simple. Nvidia and Tesla need to be trimmed down or exited or whatever it is that you want to do. And of course, it needs to be allocated into some of the other stocks so that the market value is once again realigned. Nothing's changing, right? Nothing really is changing. Your portfolio value is still at 159,200, same as what we calculated earlier. But you're just kind of shuffling around a few names so that you are more balanced once again with that target allocation. So a lot of it depends on your target allocation, of course. And once you do that, then of course it is going to be rebalanced and everything is going to actually be balanced within that portfolio. And of course, it's going to be aligned with your target allocation. So, I highly recommend creating like a very simple spreadsheet that tracks your number of stocks and of course your market values and what percentage is in which stock, right? So how much are you actually invested in which company? And that's going to give you a really visual outlook on your current position, right? Where are you overweight, where are you underweight, and you can kind of make a decision that way. It's going to be a lot more helpful in rebalancing in the future. So hope you guys enjoyed this video and found it a little bit valuable, at least a little bit. So again, let me know your thoughts, comments down below. If you're interested in joining our Discord and Patreon, link's going to be down below. I'll see if I can actually create a separate spreadsheet, which is going to help you rebalance your portfolio, and I can make that available in our Discord and our Patreon later for all the members. But yeah, hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.